it's important to look not only at the short run and the values in the market and what is on sale, but also where one is going. And if one knows where they're going 10, 20 years from now and what they want to be those core positions in their portfolio, that's where I always like to start. Hey everyone, it's Ian. I'm back with another video about dividend growth investing. Today's video is another response to a subscriber question. This subscriber asked his question to me on Facebook, and so I prioritized this one to the top of the queue. Just so everyone is aware, in addition to my YouTube channel, I have a Facebook fan page, a Twitter page, and also an Instagram page as well. So if you all want to ask questions, of course, please ask them below in the comments. But also, if you'd like to connect to me on these other platforms, I'm very much interested in gaining questions through those platforms as well. And oftentimes, I will place them at the top of the queue. So this particular subscriber is just getting started out. I'm really excited for him. I'm really proud of him. He has his first $2,000 that he's deployed into the stock market in 2 stocks, both dividend paying stocks, which is really cool. And he's about to deploy more money. And he's kind of wondering like, hey, should I deploy towards one of the 2 stocks I already own or buy a completely new stock? And just to add some context to this conversation, the specific question was about 3 particular stocks. One of them is in the healthcare industry, one of them is in the communications telecom industry, and the one that the subscriber is thinking about adding to, it's also in the telecom communications industry. Before I get into this particular question, just a general disclaimer, I cannot offer financial advice. I'm not a licensed financial advisor, and my channel is just for fun and entertainment. So basically what I'm going to do here is answer this question as if I were hypothetically in this situation, because we were all there at one point. We were all getting started out, first few $1,000s. So I'm just going to make believe here. Basically, I have a portfolio. It has $2,000 in it. And what would I do? What would I do in this situation? So I've got one healthcare stock, one telecom. I'm thinking about adding another telecom stock with my third $1,000. What would I do in this situation? So as I always do, I brought my notebook. I took down some notes, and I'm going to go through those notes. I got some really interesting ones here. So first and foremost, when one is just starting out, I am a huge fan of focus. And so the question becomes, if I have $2,000 in the stock market across 2 stocks, when I'm deploying my third $1,000, should I deploy it towards an existing stock that I already own or a net new stock? In general, when my portfolio, even with my portfolio now, but in general, when a portfolio is just getting started, when I was just getting started, I'm a huge fan of focus. And what this means is really picking the best positions, the ones I really trust in, the ones that I love, and doubling down on those positions. And so the question becomes, I have a third $1,000. Is it more prudent to diversify and add another stock? Or should I just add to an existing position? So that's point number 1. Another point on this topic, when I am deploying capital in my portfolio and I already own one stock in a particular sector, in terms of adding a net new stock to the same sector, I have to first determine, is that sector considered a risky sector? Great example of this is the energy sector, energy, oil, for example. In that sector, I'm a personal believer that it makes sense even to diversify within the sector, because from time to time, unfortunately in that sector, there are some big things that can happen that can really hurt a particular company. And so if someone is in the energy sector and has just one position, and unfortunately if that position has a catastrophe, it could tank one's portfolio if they're not really well diversified in the energy sector. So I look at the energy sector as one of those sectors where it makes sense to really diversify. Another example where one may want to diversify is technology. Technologies come and go. By diversifying, it eliminates some of the risk of new technologies versus old technologies. There are other sectors, however, that are really steady Eddie. They're stable. They're not likely to face major disruption. or if they are to face major disruption, the big players, they're just going to buy the disruptors anyways, and so they're going to do really well. And so an example of that, in my opinion, would be healthcare or consumer non-cyclical, especially with these bigger companies. Those are more non-risky sectors, at least in my opinion. And so just if I were to diversify, because this particular subscriber is asking, hey, thinking about adding a second telecom stock, I think the most important thing is to think, well, telecom industry. By the way, I don't have a lot of perspective on this industry. It's not an industry where I actually am invested. I own over 30 positions in my portfolio. Maybe I'm indirectly invested in telecom some way throughout the portfolio, but consciously investing in individual stocks in the telecom industry, that's not a focus of mine right now. And that being said, I don't want to impart that bias on anyone out there, because maybe it is a great industry. It's just not one that has made it into my portfolio yet. But the question becomes, is the telecom industry a very risky industry? Is it an industry where it warrants diversification because one of the players may just collapse? And when I come to think about the telecom industry, I don't think it's a very risky industry, at least just thinking about it in those terms. I think maybe the whole industry would face disruption. For example, all the big players could get completely disrupted by some smaller players. But thinking about dividend paying stocks in the telecom industry, diversifying amongst big players, I don't know if that adds any less volatility, any less risk to one's overall portfolio. And so that's just something to think about when adding net new positions to an industry. Is it a super risky industry or a less risky industry? Super risky industry, diversification within an industry may make sense. Another point, I like to diversify within an industry when it's an industry I love. So if you've been watching my videos for a while, you know that consumer non-cyclical, household staples, that's my thing. Healthcare as well, healthcare. When there's an industry I love and it's overrepresented in my portfolio, oftentimes I'll buy a lot of stocks within that industry because it's an industry I love. It's my passion. I believe in the industry. I like all the companies. It's so hard for me to choose that I go after a bunch of them. And so another way of looking at this for this subscriber question is, let's say hypothetically, that telecom industry was the industry that I loved. It wasn't consumer non-cyclical. For some reason, I just loved telecom. It was a big deal to me. I would then consider buying multiple stocks in the same industry because that's my industry. That's the core industry in my portfolio. That's one of the anchors in my portfolio. So then I would go all in on the telecom industry. And so that's another way I look about diversifying within an industry. I overall like a focused portfolio. But when I do diversify within an industry, it's usually if it's a risky industry or it's an industry that I love that I want overrepresented in the portfolio. So next point, it really comes down to portfolio size as well. When someone is just getting started, when I was just getting started, it's really important to focus. And I still try to focus. Well, I have over 30 stocks in my dividend growth portfolio. It actually isn't as many as it sounds because a variety of my stocks are really large positions and some of them are smaller positions. So when you look at kind of the percentage weighting of each, there's really only a handful of stocks that truly matter. Well, more than a handful, but it certainly isn't the full 30. And so the point is this: whether a portfolio is newer or more seasoned, it's always important to consider focus, because there are certain stocks out there that one is going to love that are going to drive superior results. And look, there's a variety of stocks like that, but there's also only so many. And so by adding more stocks, it's fun, but sometimes it can diversify. It can not just be diversification, it actually worsen one's returns. And so whenever I add a net incremental stock, a net incremental position, I always think about things in those terms. Here's another interesting one. And this goes back to a point I was just talking about. In one's portfolio, looking at mine as an example, not all positions are equal. Certain positions in my portfolio, I want them to be 10% of the portfolio. Certain positions, I want them to be less. Let's say no more than 5%. Certain positions, they're never going to be more than 1 or 2%. And maybe even less than 1%. And so by math, they actually have to be less than 1% if I've got 10 and 5% positions all adding up across all these stocks I own. And so the fact of the matter is I have positions that I like to weight as large, medium, and small. And so whenever one is adding stocks to their portfolio, I like to, especially when I'm building the core, I'm starting out, I like to think first about what are the stocks in the future, 10 years from now, as I keep adding money every month. What are the stocks 10 years from now that are going to be my large positions? Those are the ones I like to start with. If something is going to be an ancillary position, meaning a medium-sized position or smaller-sized position in the long run, if that's all it's going to be to me, why add to it right now at all? If I'm just starting out, I can always add to that medium or small position later. It's important to look not only at the short run and the values in the market and what is on sale, but also where one is going. And if one knows where they're going 10, 20 years from now and what they want to be those core positions in their portfolio, that's where I always like to start building first. And so I like to think of those as the large positions. I think this is a really important concept in the world of dividend growth investing. It's okay to have a lot of stocks like myself, although I would argue I probably have too many. But at the end of the day, it's really those large positions that matter, those core positions. And then one can pepper in those medium and smaller positions, ancillary positions over time. But certainly in the early days, it's something to think about. Now, going back to the question, let's just say hypothetically, telecom was my thing, that's my staple sector. Let's say healthcare too. Those are my core sectors. Look, if there were two telecom stocks that I love so much and they were going to be large positions for me, core positions, maybe it would make sense to add to them now, both in the beginning. Certainly, for me, when I first started out, I didn't have huge industry diversification. I was starting out with, if I recall correctly, consumer non-cyclical and healthcare. And so that was kind of building multiple positions in those sectors. So it's okay. So I'm just saying, though, it's important to think philosophically about these questions before making these decisions in the market. So another point, and this one we already covered a little bit, but just want to mention again, it's important, in my opinion, to diversify by industry. And so in building the vision for one's long-term portfolio, one wants to plan ahead and just think, what are the industries that I want represented in the portfolio and how do I want to build them out over time? Right now I have representation in my portfolio across many industries, including tech, healthcare, consumer non-cyclical, industrials, utilities, energy, financials, even more, real estate investment trusts, more. And so it certainly didn't start that way, but in the early days, again, it's important to think, where do I want to go? Which industries do I want represented? And if I'm going to double down on a particular industry now, in the future, how am I going to reach my goal of representing more industries? And so again, I'm not saying one is right or one is wrong. It's just a complex decision worth thinking about. Next point. This one is important. Current yield versus future yield. When one is first starting their dividend growth portfolio, it's important to think, hey, am I going to need access to these dividends now in the next 5 years to live off of? Or am I building this for the long term, 10, 20, 30 years out? If one is building it for the long term, it's my firm belief that trading current yield for growth in future yield makes all the sense in the world. And so an industry like telecom, it may be very tempting because that industry has a lot of current yield, high yields in the short run, but the dividend growth rates are a little bit slower. There are other industries like consumer non-cyclical where current yield might be a little less, but the growth rate of the dividend on certain stocks may be higher. And so if one doesn't need the yield now, one isn't going to live off of the yield now, sacrificing some current yield for growth in the dividend may make all the sense in the world, because in the long run, it may maximize one's cash flow, one's passive income. And so just the word of caution for folks just starting out and looking through my own lens when I was starting out is don't be too attracted or tempted by what are so-called yield traps. Or I wouldn't even say yield traps, just high yielding stocks that are slow dividend growth stocks and slow revenue growth stocks. And Maybe the certain positions in the telecom industry aren't slow growers. Maybe they have the best of both worlds, which is a high starting yield and a high dividend growth rate. I don't know, because that industry is not in my particular wheelhouse. But it is just a suspicion of mine that one investing in those types of industries, it's similar to like a utility style industry. Great current yield, and I own utilities, by the way, but great current yield, but slower growth rate over time in the dividend. And that may not make as much sense in a smaller portfolio, one that's just getting started, unless that particular person may need to tap into the money in the short run. So my name is Ian Lopuck. I'm from ppcian.com. I'm just broadcasting from vacation today, just on a short holiday break here with my family, and wanted to do this video to answer this particular subscriber question. I hope this video is helpful. I really appreciate the questions. Please keep them coming. They fuel this channel. I see huge things for PPC Ian in 2018 and beyond. I am attempting by the end of 2018 to hit a 10,000 subscriber goal on YouTube. Right now I'm around 1,450, so I've got a ways to go, but I want to make this an amazing channel, the best possible channel for educational resources in the world of personal finance and especially dividend growth investing. And so please ask your questions. If you have any, I will get around to them. And if you're able to like and subscribe, it really means the world to me. That's the best way you can support my channel. I want to take this minute just to thank the person who asked this question. And I'm, again, so excited for you. You were in such a wonderful position starting out, and I wish you all the success in the world. Before I leave, just a friendly disclaimer, this is not investment advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market, please do consult a licensed financial advisor first. My name is Ian Lopuck. I will see you in the next PPC Ian Dividend Investing video.